Las Vegas still glows like a mirage in the desert, but behind the neon lights, the story is shifting. For decades, the Strip thrived on promises of cheap buffets, endless remodels, and the illusion that anyone could live like a high roller for a weekend. Now, under a wave of tariffs reaching as high as 50% on steel and aluminum and a 10% baseline tax on thousands of imports, the city's foundations are beginning to shake. Casino owners who once boasted about billion-dollar expansions are suddenly freezing projects and calculating whether the cost of marble glass and lighting fixtures is even worth the gamble. At the same time, the iconic Las Vegas buffet is under siege with shrimp beef and liquor shipments caught in a trade crossfire that threatens to turn cheap indulgence into a luxury only a few can afford. Executives whisper behind closed doors about delayed investments, managers warn of food prices rising 30% to 60%, and workers on the floor wonder if tips can cover shrinking visitor numbers. The neon may still glow, but the question burns brighter. Will Trump's tariffs protect American jobs, or will they strip away the very magic that built Sin City? In 2025, the trade landscape in the United States shifted so dramatically that even the bright lights of Las Vegas could not hide its impact. What began as a bold campaign promise from President Trump to reset global trade and force partners into fair deals has turned into a complex web of tariffs that reach into every corner of the economy. For the hospitality industry, and especially the casinos of the Las Vegas Strip, the consequences are far more than theoretical. The most headline-grabbing move was the hike on steel and aluminum staples of construction and renovation, which climbed to as much as 50% under new Section 232 adjustments. These are the bones of Vegas itself, the beams that hold up glittering towers, the panels that frame glass facades, the structures that support theaters, convention halls, and arenas. For decades, casino owners have lived by a simple mantra: remodel or fall behind. Every few years, entire floors are gutted, suites are upgraded, and entertainment spaces are rebuilt to lure the next wave of visitors. But when the cost of raw materials suddenly doubles, the rhythm of constant renewal slows. Alongside the metals tariffs came the sweeping reciprocal tariff plan, which imposed a 10% baseline tax on almost every imported product, with even steeper penalties aimed at key trading partners. Goods from China, India, Japan, South Korea, and the European Union countries that quietly keep Las Vegas supplied were hit hardest. On a balance sheet that might look like percentages, but on the Strip, it translates into very specific pain points. Imagine the marble slabs from Italy that form the floors of a new casino lobby suddenly costing tens of thousands more. Consider the LED stage lighting from Japan that makes a Cirque du Soleil show dazzle now priced far beyond original budgets. Think of the seafood containers from India, Vietnam, and Thailand that stock buffets with shrimp, crab, and lobster, each order burdened with new surcharges. Even the premium tequila from Mexico or the specialty wines from France now carry higher price tags before they ever reach a bar in Las Vegas. What makes the situation even more precarious is the timing. Las Vegas has been leaning heavily on mega events, the Super Bowl, the Formula One Grand Prix, and headline residencies by stars like Adele or U2 to keep tourism strong. These events create short-term spikes, but sustaining visitor growth requires constant reinvestment in infrastructure. When tariffs inflate costs, executives are left weighing whether to move forward with renovations or delay them until rates settle. Craig Billings, CEO of Wynn Resorts, admitted in 2025 that his company would pause $375 million in projects rather than absorb unpredictable tariff-driven increases. That statement alone sent shockwaves through the industry, because Wynn has long been considered a trendsetter for luxury reinvestment. If Wynn slows down, others may follow. Meanwhile, the everyday operations of resorts are not immune. Furniture fixtures and equipment known in the industry as FF&E are the silent but vital elements that keep properties competitive. From custom Italian chandeliers to high thread count linens sourced from Asia, these items are what transform a hotel room from average to unforgettable. A 10% hike across the board means procurement budgets that were already tight are now under strain. For mid-tier properties that compete on price rather than luxury, the math is even harsher. Do they pass the costs on to customers in higher room rates and pricier menus, or do they cut back on quality and risk disappointing guests? Either choice chips away at the delicate balance that makes Sin City thrive. It is this collision between the spectacle that defines Las Vegas and the invisible machinery of global trade that makes 2025 such a dangerous year. Tariffs designed to punish foreign producers are in practice punishing the very image that Las Vegas sells to the world. And unlike manufacturing plants that can adjust production or farmers who can shift crops, the casino economy depends on consistency, dazzling lights, endless upgrades, and indulgence at a price that feels just within reach. If tariffs erode that foundation, the entire ecosystem of the Strip, from billion-dollar corporations to the cocktail waitress depending on tips, feels the squeeze. When the conversation in Las Vegas turns to tariffs, the real tension lies in the divide between CapEx capital expenditures like construction and large-scale upgrades, and OpEx, the day-to-day operating expenses that keep the casinos running. For decades, the Strip has thrived on massive capital projects, glittering new towers, multi-million-dollar theater redesigns, and constant overhauls of lobbies and gaming floors. These are the investments that keep tourists flying in, convinced they are experiencing something new. But in 2025, tariffs have hit the lifeblood of these projects. Craig Billings, CEO of Wynn Resorts, made headlines when he admitted that Wynn would delay roughly $375 million in upgrades, including a remodel of the Encore Tower, because the cost of imported materials had risen unpredictably. His comment that tariffs created too much volatility to move forward rang loudly in boardrooms across the city. In Las Vegas, when Wynn slows down, the rest of the industry pays attention. Other giants have tried to calm fears. MGM Resorts under CEO Bill Hornbuckle has said that the immediate impact of tariffs on its projects is minimal. Caesars Entertainment, led by Tom Reeg, echoed a similar sentiment, claiming that near-term exposure is limited and that they are focused on maintaining guest experience. But beneath the public optimism, analysts note that even the largest operators are quietly adjusting their strategies. Some are respecifying building materials to source domestically, while others are spacing out renovation cycles longer than usual. On paper, this softens the blow. In practice, it risks dulling the competitive edge that defines the Strip. If guests notice that hotel rooms look a little less fresh, or theaters take longer to get new tech, the city's carefully built aura of constant reinvention begins to fade. On the OpEx side, the story is different. Casino executives point out that food, beverage, and everyday supplies are certainly more expensive under new tariffs, but the industry has learned to absorb shocks before. When supply chain disruptions during the pandemic forced operators to pay premiums for meat, liquor, and cleaning supplies, they adjusted menus, raised prices slightly, or found alternate suppliers. In that sense, tariffs are painful, but manageable for operating costs. A steakhouse can increase its entree prices by a few dollars, or a buffet can quietly cut back on imported crab legs while expanding cheaper domestic options. Guests grumble, but they rarely boycott. CapEx, however, cannot be hidden or smoothed over. The cancellation or delay of a project worth hundreds of millions of dollars reverberates far beyond a single property. It affects contractors, construction workers, designers, and the entire supply chain tied to Vegas reinvestment. It also ripples across the financial markets as investors see signs that once reliable growth engines are pausing. A single statement about deferred capital spending can wipe billions off a company's valuation overnight, especially when Wall Street has been conditioned to expect perpetual expansion on the Strip. The divide between CapEx and OpEx creates a unique kind of tension. Daily operations can limp along under tariffs, but the long-term sparkle of Las Vegas is at risk if capital projects stall. The Strip is not Orlando, where theme parks can rest on a handful of classic rides for decades, nor is it Atlantic City, which long ago ceded its competitive edge. Vegas thrives by tearing down the old and replacing it with the new before visitors ever get bored. Tariffs strike at that rhythm, directly forcing casino executives to gamble with something they hate most: uncertainty. And in a business built on calculated odds, that uncertainty may prove to be the most dangerous bet of all. If there is one place where visitors feel tariffs directly, it is on the plates and in the glasses of Las Vegas. For decades, the city built its reputation on extravagant buffets, bottomless shrimp, premium cuts of steak, and cocktails crafted with the best liquor from around the globe. But in 2025, the economics of indulgence have changed. Tariffs on imported seafood from countries like India, Vietnam, and Thailand, which collectively supply over 90% of America's shrimp, have driven costs sharply upward. The Nevada Restaurant Association warned that overall food prices in the state could climb between 30% and 60%, forcing both strip restaurants and neighborhood diners to make tough choices. A buffet that once dazzled with unlimited crab legs now has to scale back portions, replace them with cheaper domestic alternatives, or hike the price of entry in ways that turn a $39 feast into a $59 splurge. The ripple doesn't stop at seafood. Imported tequila from Mexico, wine from France and Italy, and even staples like coffee and rice are all tangled in the tariff net. For luxury properties, the instinct is to absorb some of the pain to protect their brand image. Nobody expects the Wynn or Bellagio to serve bargain bin champagne. But for mid-tier and budget resorts, where value is the selling point, the pressure to pass costs onto consumers is overwhelming. That means guests who once felt like kings at a modest price suddenly face sticker shock at the checkout. For a city built on the illusion of affordable luxury, that shift is dangerous. The irony is that some domestic producers are cheering. Shrimp farmers in states like Indiana and Texas have long complained they could never compete with low-cost imports flooding the US market. Now, with tariffs pushing imported prices higher, their products suddenly look more attractive. One Indiana farmer called the tariffs a blessing, saying, "If imported shrimp costs $7 a pound, customers will finally consider my fresh product." For them, Trump's trade war is a lifeline. But for the restaurants that rely on consistent volume and predictable pricing, especially in a place like Las Vegas, where thousands of pounds of shrimp are consumed daily, it creates a new headache. Behind the scenes, operators are experimenting with substitutions. Menus are being tweaked to highlight domestic beef, locally sourced produce, or plant-based options that avoid tariff costs altogether. Chefs are tasked with maintaining the wow factor while quietly reducing reliance on imports. At a strip steakhouse, that might mean showcasing American Wagyu instead of Japanese Kobe. At a buffet, it might mean expanding pasta stations or dessert spreads to mask slimmer seafood offerings. Guests may not notice at first, but regulars already whisper about smaller portions and higher prices. In truth, the food and beverage sector embodies the double-edged sword of tariffs. On one hand, they protect certain American producers and theoretically strengthen domestic supply. On the other, they undercut the very promise that Las Vegas has sold for generations: the ability to indulge without breaking the bank. A weekend getaway loses some of its magic when the shrimp cocktail costs $25 and the buffet line feels more expensive than a Michelin-starred restaurant back home. And while executives insist these changes are temporary, history shows that once prices rise in Vegas, they rarely go back down. In the battle over trade, the dining table has become a front line, and the guests footing the bill are starting to notice. If tariffs squeeze construction budgets and buffet lines, the broader numbers show an even more troubling trend: fewer people are coming to Las Vegas. According to the Las Vegas Convention and Visitors Authority, LVCVA, as of June 2025, visitor volume was down 11.3% compared to the same month last year, and down 7.3% year to date. At the same time, the average daily room rate ADR fell 6.6%, and revenue per available room RevPAR plummeted 13.8%. Gaming revenue held steady, but that stability masked the real weakness non-gaming spend. The restaurants, shows, and shopping that have become the Strip's main profit engines is under heavy strain. the decline didn't happen in a vacuum. In 2024, Vegas hosted a series of spectacular events, the Super Bowl, the Formula One Grand Prix, and a string of celebrity residencies that drew global crowds and pushed hotel rates to record highs. By comparison, 2025 has fewer headline attractions, leaving the city vulnerable to broader economic headwinds. International travel, once a growing share of Vegas tourism, has also softened. Tariffs and retaliatory trade tensions make airfare, visas, and spending abroad less attractive, especially for high-rolling visitors from China, Japan, and Europe who used to anchor luxury bookings. Fewer global guests mean fewer baccarat tables filled, fewer luxury suites sold, and fewer high-end dinners ordered. Meanwhile, American consumers are feeling the pinch of inflation and higher prices across the board. A Vegas trip, which once felt like an affordable escape, now requires rethinking budgets. When guests see higher buffet prices, pricier cocktails, and surcharges baked into room rates, they cut back elsewhere. That means fewer shopping sprees at the Forum shops, fewer tickets to shows at Caesar's Palace, and less willingness to gamble on the Strip when every dollar already feels stretched. For the local workforce, the pressure is real. Even with the new no tax on tips policy, allowing service workers to exclude up to $25,000 in tips from taxable income between 2025 and 2028, there's only so much relief. If fewer people are visiting the total tip pool, shrinks, leaving cocktail servers, dealers, and valets worried about making rent. What makes this moment especially precarious is that Las Vegas has built its entire brand on resilience. The city survived the 2008 financial crisis, rebounded from the pandemic collapse of 2020, and reinvented itself time and again with new attractions. But tariffs create a unique challenge because they ripple through both supply and demand. On the supply side, they inflate costs for the businesses that make Vegas run. On the demand side, they sap the spending power of the very tourists those businesses rely on. The result is a pincer movement that squeezes the Strip from both ends. Executives warn privately that if visitation continues to decline at this pace, it could force them into more aggressive cost-cutting, delaying not just capital projects, but also trimming staff and amenities. For a city where perception is everything, even the rumor of scaling back can snowball into lost bookings. Tariffs may not be the sole reason visitor numbers are down, but they amplify every weakness already in play. In 2025, the question isn't just how Vegas will adapt to higher costs, it's whether enough visitors will still come to make those adaptations worthwhile. Every tariff creates both winners and losers, and in Las Vegas, the dividing lines are becoming clear. On the winning side are domestic suppliers who can now undercut foreign competitors, shut out by higher costs. American producers of steel and aluminum are finding new buyers as casino operators look to source materials domestically, even if logistics make the process slower. Domestic seafood farmers, particularly shrimp operations in Indiana and Texas, also see a boost. With tariffs driving imported shrimp prices higher, their products suddenly look competitive, and for the first time in years, Strip restaurants are exploring contracts with US farms that once seemed too expensive. For these groups, tariffs feel like long-awaited protection. But the losers list is longer, and it hits closer to the daily operations of the Strip. High-end restaurants that rely on imported lobster from Canada, Kobe beef from Japan, or rare wines from France must either swallow the cost or pass it along to guests. Mid-tier buffets built on volume and value find themselves squeezed hardest. A property like the Flamingo or the Excalibur cannot easily charge $60 for a buffet without alienating budget-conscious visitors, yet their food costs rise just the same as the luxury resorts. Construction contractors and FF&E suppliers are also struggling as projects that once provided steady work are now delayed or cancelled outright. For the thousands of local workers who depend on these projects, the pause means fewer hours and thinner paychecks. The casino owners themselves are stuck in the middle. Companies like Wynn, MGM, and Caesars must answer to Wall Street, where investors expect growth and constant reinvention. Cutting capex to preserve margins pleases the accountants in the short term, but risks dulling the brand in the long term. Passing higher OPEX costs onto guests keeps profit margins stable, but chips away at the customer experience that makes Vegas unique. It is a lose-lose proposition, and every decision feels like gambling against the house's own future. This balancing act has already produced tactical adjustments. Resorts are redesigning menus to feature more domestic beef and locally grown produce, negotiating bulk contracts with American suppliers and quietly reducing portion sizes on luxury items. On the construction side, designers are re-specifying materials, substituting domestic options where possible, and slowing down renovation schedules. None of these moves are catastrophic on their own, but together, they represent a subtle retreat from the aggressive expansion culture that made Sin City famous. In the end, tariffs may protect a handful of American producers, but in Las Vegas, the winners are few and the losers are many. The city thrives on excess, on giving visitors the feeling that nothing is beyond reach. Tariffs chip away at that illusion, one buffet, one remodel, one cancelled project at a time. And for a destination that depends entirely on perception, the risk is that guests start to wonder whether Vegas is still the city where dreams are bigger than the bill. In public, the voices of Las Vegas casino owners tell a story that is as divided as the industry itself. On one side, you have executives like Craig Billings, CEO of Wynn Resorts, who in early 2025 admitted the company would delay roughly $375 million in capital projects, including the remodel of the Encore Tower, because tariff-driven costs made the numbers too volatile. His candid acknowledgement that we simply can't justify the spend right now was rare honesty in an industry that usually prefers optimism. It sent shockwaves through the Strip, because Wynn has always been the pace setter for luxury, and if Wynn is hitting pause, it signals the pressure is real. On the other side, leaders like Bill Hornbuckle of MGM Resorts and Tom Reeg of Caesars Entertainment struck a more reassuring tone in their earnings calls. They insisted that the immediate impact of tariffs on operations and projects was minimal, framing the new costs as temporary bumps in the road. Their message was simple: don't panic, Las Vegas is resilient. Yet analysts listening between the lines noticed subtle hedges, phrases like monitoring the situation closely and adjusting procurement strategies that hinted at deeper concern than the soundbites suggested. The calm front was for investors, but the private boardroom conversations were more cautious. Adding to the chorus were local voices outside the boardrooms. The Nevada Restaurant Association openly warned that tariffs on food imports could drive menu prices up by 30% to 60%, putting restaurants in a bind. One Strip restaurant manager was quoted saying, "We can't serve shrimp cocktails that cost more than a prime steak." Workers on the ground echoed similar fears. Dealers, cocktail servers, and valets whispered that even with the no tax on tips policy, fewer visitors meant thinner pockets at the end of a shift. For them, tariffs weren't abstract trade policy, they were the difference between paying rent and falling behind. Taken together, the montage of voices paints a city wrestling with uncertainty. Casino CEOs try to reassure investors, trade associations sound alarms about spiraling costs, and workers fear shrinking paychecks. The contradiction is telling. The very leaders who built Las Vegas on spectacle and confidence are now forced to admit that global politics can hit the Strip harder than any losing streak. And as each quarter passes with delays, rising prices, and falling visitation, the gap between what executives say publicly and what they plan privately only grows wider. The story of Trump's tariffs and Las Vegas is far from finished. As new rounds of trade policies roll out, the Strip is watching closely to see whether rates will settle or whether the next executive order will push costs even higher. On the policy front, steel and aluminum remain the most sensitive categories, with tariffs already at 50%, while the 10% baseline tax continues to ripple through everything from imported chandeliers to bottles of French wine. On the market side, the monthly reports from the Las Vegas Convention and Visitors Authority will serve as a scoreboard showing whether visitation rebounds in late 2025 or if the downward slide continues. And in the corporate world, earnings calls from giants like Wynn, MGM, and Caesars will reveal whether they choose to absorb the pain, pass it on to customers, or pull back further on reinvestment. But beyond the numbers, the real question is, psychological, will visitors still see Sin City as the place where anything is possible, or will rising costs and scaled-back experiences break the illusion Las Vegas has survived recessions, crises, and even a pandemic? But tariffs strike at its most fragile point, its promise of indulgence at a price that feels worth it. If that promise erodes, no neon sign will be bright enough to hide the cracks. For now, the Strip waits, caught between optimism and fear, hoping that the dice roll in its favor. So the next time you walk past a buffet line, check into a hotel room, or sip a cocktail on the Las Vegas Strip, ask yourself, are you paying for the experience or for the politics behind it? That's the true cost of tariffs. And in Vegas, everyone, owners, workers, and visitors alike, has skin in the game.